The non-farm payroll report for October came in 3 standard deviations lower than expected. Essentially a black swan event, if you will. But did markets respond accordingly? No. They actually make 0 cents at all. I will try to put a 0 cents market into context for you, because who cares about what happened today? It's all about what's going to happen into the future. That is the sole reason you invest your money. The S&P was up, well, over 0.5%, including this move now in after hours, up another 0.1%, and 10-year Treasury yields skyrocketed after only 12,000 number for non-farm payrolls. Yes, let me be the guy that points this out, but Wall Street says the Boeing strike cost us 44,000 jobs. The hurricanes cost us an inquantifiable number of jobs that maybe it was not as bad as we think, or the actual number shows us because of these one-off distortions. Well, fine. But it wasn't great either. No matter which way you want to spin this report, it was not a strong report. And 10-year Treasury yields went up about 9 basis points. Something you would expect to see if we got a super hot inflation report. I don't think these two are similar in nature as far as what this means for the Fed. In fact, a 12,000 jobs report should clear the way for the Fed to cut rates and ease monetary policy. But let me give you a little bit of a secret, okay? Wall Street, well, we don't care about earnings anymore. Big tech earnings are out of the way. Nvidia is going to be good. Nothing to worry about there. It's all about the election. It's all about the election. And, well, markets are kind of pricing in a specific outcome. David Rosenberg writes on X the definition of irrational despondency. I don't know if I said that right. The Treasury market responding the very same way to the meek 12,000 payroll headline today as the 254,000 surge we saw exactly 1 month ago. I am not sure at all what the bond traders, investors, are seeing, but something tells me they are sniffing out a GOP sweep on Tuesday. That is a Republican sweep. Between the tepid employment report, even after all the strike and storm adjustments, and the contractionary 46.5 ISM reading, there really is no other plausible explanation for today's yield melt-up. And Peter Burskin, another notable bear, he says this morning's narrative is that we should ignore the payroll survey because it was distorted by the hurricane and should focus instead on the household survey. Okay. But employment fell by 368,000 in the household survey. So that's to my point. No matter what you want to look at, no matter what criteria you look at, it was not great. Even if it was not 12,000 jobs like bad, it was still bad. And there is no justifiable reason why 10-year Treasury yields went up 10 basis points today to 4.386%. The only justifiable reason for this is, as the 2 prior individuals mentioned, well, you're pricing in a Republican sweep. Now, for this, we have to use a little bit of common sense. Okay, Trump's tariff policies, they're not really tariff policies. They're tariff rhetoric. But are these things actually going to be enacted? No, probably not. Because we all know that's not going to be good for the economy. It's not going to be good for Americans, okay? It's a negotiating tool. So I think we need to think about the markets here from 2 perspectives. Let's say if Trump wins, longer term, what does this mean for bonds? What does this mean for stocks? Lower corporate tax rates, good for stocks. Less regulation, good for stocks. Lower inflation, good for stocks, as long as we're not in deflation territory. Well, if you're in the camp that Trump's actually going to enact these tariffs that he has talked about, then that would be bad for the economy. That'd be very bad for the economy. If you're in this similar camp as I am, and it's really just a negotiating tool to create fair trade deals, and it's not something, I mean, You really think all the imported steel is going to get hit with 100% tariff, 200% tariff? No, okay? That's just not going to happen, right? Some of these things are ridiculous. And from a sound, reasonable perspective, they sound ridiculous. So if those things do not happen, if government spending and deficits, inflation do not run rampant under a Republican presidency, as the markets are pricing in, markets over the next 3, 6, 12 months are going much higher. Okay, that's my view. My view is longer term, 12 months from now, markets might be 20% higher than where they are today. Let's take the short-term perspective of this, though. We have 2 trading days now until the election. The bond market is clearly pricing in a Trump win, more deficit spending, and higher inflation. Even though I think longer term that will be proven wrong, in the near term, that's what the markets believe, because the markets are actually believing the tariff rhetoric. Okay, this is your opportunity. I want you to pay very close attention to this, because long term, it's not going to be nearly as bad as the bond market is pricing in. And let me tell you, the bond market is pricing in something horrific, with 10-year Treasury yields that went from 3.62% up to now today, if you're rounding here, 4.39%. It's not. We're going to be facing maybe deflation, hopefully not, but very low levels of inflation, I personally believe. Okay. But in the near term, with 2 trading days left to the election, with this narrative that Wall Street is feeding, it is very well possible next Monday and Tuesday could be bad. Okay, let's just say that. It's very possible they could be good as well. If I told you I had any certainty on what's going to happen Monday and Tuesday, I would be lying to you, because nobody knows what's going to happen Monday or Tuesday. Do we pay more attention to the bond market? I don't know. Do we pay attention to the fact that that could mean lower corporate tax rates and maybe higher earnings at companies? I don't know. But I can tell you definitively, if we have the results of the election on Tuesday night, heading into Wednesday's probably going to be a very green day for markets, no matter who wins. The caveat here is if we get a Republican sweep, then there might be less of a rally. There might be some fears there. Okay, because that just means it's going to be easier to spend more, at least from Wall Street's perspective. So best case scenario, we know who the president is Tuesday night, Wednesday, and it's a split Senate. That's simple as that, right? The other scenario is we have a contested election, and we don't know who the president is for a significant amount of time. Could be a couple of days, could be a couple of weeks, could be a month or longer, like Al Gore and Bush in 2000. That would be the worst case scenario. Although I think we're going to know who the president is by Wednesday, that is a possibility. In that scenario, liquidity dries up. There's not going to be much moving in markets from the perspective of, just think about the different candidates and the areas that would benefit in markets. Like, Are you really going to go out and buy a bunch of solar stocks, green energy stocks, if you think that, or you don't know who's going to win, right? If it's still a toss-up, probably not. Are you going to go out and buy a lot of big tech companies that'll benefit from a lower corporate tax rate, that are highly profitable? Probably not, right? You're going to wait. You're going to see where you want to position your money when you get the actual results. And the higher 10-year Treasury yields go, the more I think, no matter who wins, as long as it's not a sweep in either direction or the other, you're going to see a rally after the election, or after we get the results from the election in. Okay, whether that's a week, a couple of days, who knows? Now, I personally, again, believe we're going to have the results of the election Wednesday. But a lot of people out there think it's going to take a week or two. So my previous 10% correction call incorporates not knowing, the president, at least for a period in time. Now, I also think after the election, after the initial kind of rally that you could see in the broader markets, you could see winners and losers that will distort the markets a little bit more. And I ultimately think it will come down to the holiday quarter, what these numbers start to look like for consumers and what could be another growth concern. Now, I don't want to speak on the whole 10% correction call too much. I said we were going to have a 10% correction in the next 6 weeks. That was on October 21st. Since then, the markets have fallen 3%. We still could have a ways to fall. And you could do that relatively quickly if we don't know who the president is coming on Wednesday, and especially if it's a nasty contested election. But what I can say with certainty is the bond market is pricing in a Republican win and what could be a sweep. And that doesn't look pretty. Now, I also want to remind you that this is kind of the normal correlation between bonds and stocks. Yields going up means bonds are falling. Stocks went up today. That's actually normal. You should expect stocks to go up when bonds go down, because when bonds go down and yields go up, that means interest rates are going higher. If the economy is doing well, interest rates should go higher. So to someone out there that wants to say it's just because the economy is doing well, that's a fair point. A lot of the data we've seen has shown the economy is doing well, but not the data we got today. So I will acknowledge the people that say bond yields are going up because the economy is doing well. That's fine. But not today. That did not happen today. And that's why this is really just political things getting priced into markets. Now, I will point out the fact that Amazon was up 6% today. That had a large weighting in what the markets did. You also had Microsoft up and Nvidia up as well today. Nvidia was up 2%, Microsoft up 1.26%, Amazon up 6%. Apple weighed down the index, down about 1.6% today. So really at this point, I think it's all about the election. Now, personally, I did not go into next week with any hedges of any kind. It wouldn't surprise me if the end of the year rally that people are talking about in markets, Tom Lee, many others have talked about this, gets priced into the markets right before the election. It is possible that you do get some excitement heading into the election, looking past and pricing in that end of the year rally, that after the election, kind of rally. The problem would be if we don't know who the president is, then that rally would be very short-lived. And it really just has to do with liquidity and money flows. Right? You're not going to make a big move before you know who the president is going to be, or the makeup of the Senate, so on and so forth. Now, I will just reference what JP Morgan said 100 years ago. He said that if you bet on America long term to fail, you will always go broke. And I think that really resonates with where we are now, with the expectations that we have, that for some reason, a certain political figure, being the president, is really going to have that much of an impact to the American economy. It's not going to change much, okay? Even if policies can be enforced, presumably the one in charge is going to make the best decision possible for America with harming as little Americans as possible. I hear the narrative on Wall Street right now that we're going to have higher inflation, higher deficits, a worse off fiscal stance. In all reality, we're probably going to get more rate cuts. We're probably going to have a stronger economy, lower corporate taxes, which is good for the economy, and good for markets. So beyond this blip in history, if it even will look like a blip on the charts, if we do get a 10% correction, all the 10% corrections we've ever had have always been bought up, usually in a short amount of time, then you're going to look back at this and say it was obvious. You wanted to be bullish after the election. Now, maybe not immediately after, if we don't know who the president is, but if we do get selling in markets, that is your opportunity. As I said just a few moments ago, you want to pay very close attention to this, because the narrative right now is if one candidate wins the White House, it will change America. It will make things worse. And you see that also reflected in the bond market. And it's just not true. It's kind of like I could imagine skydiving. If you've ever went skydiving, you could probably relate to this down below in the comment section. I have not. Okay, I'm not going to lie to you. But I think this works well with skydiving. I hear, at least, you're super nervous about it for maybe days, weeks in advance. You're super nervous in the plane. You're terrified. And then after you do it, you want to go again. People tend to love it after they do it once. That's kind of like maybe how we're pricing bonds with a certain specific candidate called T-Man. People think it's going to be so bad, and then once it's there, it's not as bad. And this could end up playing out in November if we get the results of the election fast enough and there's not a large delay. Then Wall Street might say, we really overestimated how bad things were going to be. And I think even more so from a tactical perspective, bond yields have went up a lot recently. And I think we're in a position where you could probably see a reversal to that in the not so distant future. Even from a tactical perspective, it would make sense to see a little bit of a bounce in bond yields. Even consider next Thursday, we have the Fed meeting, and the Fed's going to try to push down bond yields, right? The Fed's going to tell you they're going to continue to cut rates because the Fed doesn't want yields to continue to go higher. That makes their job harder. That makes the odds of a hard landing harder. And hell, we just had 12,000 jobs. Minus out whatever you want. Look at the household survey, negative over 300,000 jobs. The Fed doesn't want the economy tightening as the economy is slowing down. So next week, you're going to hear very bullish things from the Fed, coincide that with hopefully the election results, and you could actually have a pretty optimistic cocktail on your hands. Vice versa, if we don't know who the president is, there's going to be more uncertainty and a lack of liquidity, and that will cause some pretty severe selling in markets. But it will be a massive buying opportunity. So with that said, let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.